If you're an Australian homeowner, I'm willing to bet you felt a bit of anxiety creeping in lately. You know, the conversation around interest rates has just shifted so dramatically, and it's leaving a lot of us wondering, what's next for my mortgage? Okay, let's dive into this because really, understanding what's going on is the very first step to taking back control. And hey, it's not just a feeling. Headlines like this one, they capture the mood perfectly. This is a real concern for so many households that are already feeling the pinch from the cost of living. This isn't just background noise, it's a huge signal that now is the time to pay really close attention to your home loan.
And that's the big question, isn't it? It's so easy to feel kind of powerless when you're up against global markets and central banks. But the good news is, you're not. So that's what we're going to do here. We'll break down the why behind all this and then get straight into a clear action plan. We've got a pretty simple roadmap for this. First, we'll look at the actual evidence for a potential rate hike. Then we'll get our heads around the economic stuff that's pushing them up. After that, we dive into the good part, the solutions, the power of refinancing, and a brilliant little tool called an offset account. And finally, we'll tie it all together into an action plan. So let's get right into it. Is this whole rate hike threat actually real? Well, if you follow the money, the financial markets and the Reserve Bank's own notes are telling a pretty clear story. So here's our starting point. After a few cuts, the RBA cash rate is sitting at 3.60%. Now, for most of last year, the whole conversation was about how much lower it might go. But wow, that conversation has done a complete 180. And this slide just shows you how incredibly fast things changed. Look at this. In early December, the market was 50-50 on a rate cut. Fast forward to late December, after some warnings from the RBA, and suddenly it's pricing in a 100% chance of a rate hike. That is a massive, massive turnaround, and it's all being driven by some really stubborn economic data. So what on earth caused this sudden flip? Well, it boils down to one word: inflation. Let's take a quick look at what that actually means for you. You know, this chart makes it so clear. The Reserve Bank really has one main job: keep inflation in that 2 to 3% target range. Well, as you can see, at 3.8%, we're well above that. And when inflation stays too high for too long, the RBA's main tool to cool things down is, you guessed it, raising interest rates. And it's not just one thing pushing prices up. It's more like a perfect storm. We're all spending more than expected. The cost of services and building is still high. And with so many people in jobs, the whole economy is just running a bit hot. All these things are putting pressure on inflation and basically forcing the RBA's hand. Okay, so we can't control inflation or the RBI, I get it. But what we can control is our own mortgage. And the first and honestly the most powerful move you can make is to just look at refinancing. And here is why it is so powerful. Just look at that number. Research from Kenstar shows that switching could save a typical borrower over $6,500 in just 2 years. Think about that. That's a huge financial buffer against any future rate rises. It just goes to show you, sitting back and doing nothing can literally cost you thousands. Now, of course, you've got to weigh things up. There can be some cost to switching, like discharge fees from your old lender or application fees for the new one. And yeah, if your equity is below 20%, you might have to deal with lender's mortgage insurance. But as you can see here, the potential benefits, a lower rate, maybe some better features, and thousands in savings often just blow the costs out of the water. And the process itself, it's more straightforward than you might think. It really just comes down to these 5 steps. First, figure out where you stand. Then, do some research, and always start with a call to your current bank. After that, just gather your docs and apply. The new lender really handles most of the heavy lifting from there. All right, now for your second power tool. If refinancing is your defense, think of an offset account as your secret weapon for your offense. It actively attacks your loan balance every single day. So what is it? It's really simple. An offset account is just a normal, everyday bank account that's linked to your home loan. You can get your salary paid into it, you can pay your bills from it, but here's the magic. Any dollar sitting in that account is offset against your loan. This example shows it perfectly. Let's say you have a $400,000 loan. If you have $100,000 sitting in your offset account, the bank only charges you interest on $300,000. So you're not earning a tiny bit of interest on your savings, you're saving a huge amount of interest on your loan. And the best part, because you're saving it, not earning it, that benefit is completely tax-free. People often ask how this is different from a redraw facility. Well, think of it like this. With an offset, your money is in a separate account, ready to use whenever you want. With redraw, you're paying that money directly into the loan itself. Now, the huge advantage of an offset comes if you ever decide to turn your home into an investment property. Using an offset keeps the loan's original size intact for tax purposes, which can be a massive win down the track. Okay, let's look at the real-world impact, because this is where it gets really exciting. This is where your own savings become your best weapon. Based on one scenario, just by keeping a steady $40,000 in an offset account against a $400,000 loan, you could shave more than 6 years off your mortgage. You're not even making extra repayments, you're just parking your cash in a much smarter spot. But what happens when you combine that offset with just a little bit of extra effort? By adding just $100 a week in extra savings, that same loan gets paid off almost 10 years early. I mean, think about that, 10 years early. This is the power of compounding savings working for you, not against you. It turns a 30-year marathon into a 20-year sprint. All right, we have covered the problem and we've covered the tools. So let's put it all together into a simple, straightforward action plan you can use to take back control of your finances. Here it is, 4 simple steps. 1, call your bank. Ask for a better rate. Don't be shy about it. 2, if they don't play ball, shop around. Your equity is your power. 3, make your money work harder for you. Get your salary paid into that offset account. And 4, and this is so important, don't set and forget. Check in on your mortgage every year. It could save you a fortune. So ultimately, it really all comes down to this one question. The economic winds are always going to change. That's a given. But by being proactive, by using the right strategies, you can build a financial fortress that puts you firmly in the driver's seat. The power truly is in your hands.
Cheers for watching. If this breakdown helped you make sense of the 2026 rate hikes, do us a massive favor. Hit that like button and subscribe to the channel. It really helps us keep bringing you these Aussie finance updates. Don't forget to drop a comment below and let me know. Are you fixing your rate or staying variable? Thanks for the support, and I'll catch you in the next one.